All right, for a deeper look at the Fed and the U.S. and global economy, we're joined by David Goldin. He's the founder and president and CEO of Capify, a small business lender here in the United States. David, thanks for joining us.
Thank you for having me tonight.
David, let's start off with the Fed sounding a little less optimistic than last time. What do you make of the last minutes? Is an interest rate hike not on the cards for the foreseeable future?
Well, I think the Fed has a very tough job. It's more of an art than a science of what the reaction that the markets are going to do based on not only what the Fed does, but what the Fed's going to infer to do. And I don't think the Fed really anticipated this vast market sell-off in January based on their recent hike in December. So I think the Fed really has to take a watch and wait and approach right now as far as when the next rate hike will come.
Well, the Fed certainly did give markets a big heads up. They were saying, threatening, warning, saying we're going to raise interest rates, we're going to raise interest rates for a very long time. In hindsight, was it a mistake to have that 25 basis point hike in December?
I don't think it's so much the 25 basis points. That's what's shocking the market. I think it's the mindset, especially the Fed initially saying that we could have as many as 4 rate hikes in 2016. So I think it's more the mindset and a lot of uncertainty and a lot of volatility in these markets that's really making the markets behave the way they're behaving.
Well, those 4 rate hikes do not seem to be what the street is betting on now. When do you think the next hike would be, if in fact we'll see one to the upside?
Right. I think the Fed's going to need to see a few things happen before they could really consider a hike. First and foremost, we need stability in these markets. We need consumer confidence high. We need business owner confidence high. We have to make sure that the economy can grow. So until the signs are there, perhaps the end of 2016, but I would be very shocked if in the short term the Fed's raising rates anytime soon.
Well, the Fed, particularly Janet Yellen testifying to Congress, did emphasize a lot of concern about the growth slowdown in China and other emerging markets as well, but a big focus on China. She said that that was a drag on the U.S. economy. How much of a drag do you think it is?
Well, I think what people they may be overestimating and overreacting is that they're still predicting China to grow at a 6-7% rate, which still is very respectable when you compare it to other markets around the world. The challenge is people were accustomed to China growing at double-digit rates, and especially the majority of the S&P companies in the U.S., there's a lot of buyers in China that many of the S&P companies are selling to, and I think there's macroeconomic concerns that even the U.S. companies are going to see slowdown based on less Chinese spending and less China growth.
But David, we've been talking about this China soft landing for a long time now. China has been rebalancing its economy to a consumer-driven one. This really shouldn't come as a surprise to anyone. Why is it such a shock to the system then?
Well, I think it's the world we live in, right? People don't want to face reality sometimes, and I think that people don't want to give up a good thing, especially the last 7+ years of the U.S. economy right after we had the global crisis. So I think the combination of the Fed raising rates, even though we knew it was coming for a long time, and the reaction that the markets had is really the first wake-up call now that economists and both consumers, businesses, and market traders are now realizing, wait a second, this really is happening.
Well, perhaps something that did come as more of a surprise is the huge plunge that we've seen in oil prices. They've lost about 70% over the last year or so, and the Fed did highlight that as a particular concern. Why is the drop in oil such a big issue to the U.S. economy?
Well, the average consumer probably thinks it's a great thing that we have low oil prices. But keep in mind, we've had low oil prices now for a couple of years, but yet we're still seeing slowdown. Many countries are dependent on oil. So the emerging markets, we have to be concerned about that their revenues are going down. The U.S. is also, compared to years ago, is now also producing oil. We're seeing the U.S. oil companies having some issue. And governments are losing taxes all around the world, especially in unstable regions like the Middle East, where they don't have the oil revenues they may have had. There's also some concerns of stability within the governments when they don't have proper budgets to perhaps control stability within a region.
So David, a rate hike for the foreseeable future not looking likely, but what would it take for the Fed to reverse course and cut rates again? I'm not even talking about going into negative rates.
Correct.
But a number of central banks since the 2008 crisis have raised interest rates and had to reverse course. New Zealand, Israel, Canada, Sweden going into negative rates. So what would it take for the Fed to cut now?
I think they need to see the economy growing again, right? I think right now everyone from professional investors to the average investor has a lot of fear. People don't want to get up one day and each day and being concerned the market's dropping 500 points. You know, their retirement funds are going away. Businesses are afraid to invest in their businesses to some extent. So we have to really make sure that the business owner confidence is there.
But what would need to happen for the Fed to be like, you know what, this was a mistake, we're going to cut back by 25 basis points or less, perhaps?
Well, I think we keep seeing the markets plummeting and we don't see a bottom, and unemployment gets higher and the market keeps falling, I think the Fed's going to have no choice but to perhaps reduce the rates again. Again, it's not the 25 basis points also that's causing all this. It's the psychological impact, especially the Fed's message back in December that there might be 4 rate hikes. If the Fed decreases rates again, that could, again, it's not the 25 basis points, it's the psychological analysis of what they're doing that could, again, stimulate the economy.
Psychologically negative interest rates, just talk of that. Is that insane?
I think they're going to have a hard time if you look at the studies. Banks, for example, have a hard time right now lending to small businesses. It's not very profitable. That's like why companies like ours, Capify, exist. There are tons of studies that when there are negative interest rates, the banks actually make less money lending money out. So it could also impact what we need, which is stimulus to the small businesses, which is giving them easy access to capital.
All right, we're going to have to leave it there. Thank you so much, David Goldin, founder and president and CEO of Capify.